Have you ever noticed how when the economy weakens, it feels like your investments start to lose strength? While many people worry about inflation, recession, and rising prices, there's one sector that seems to remain resilient against any crisis. Today, I won't be talking about buying a Ferrari, even though many of us would love to own one, but about something even more strategic: investing in companies that enable luxury. Can you imagine protecting and growing your wealth by investing in a market that doesn't know the word crisis? If you're interested in why major investors, tycoons, and sheikhs choose luxury as their financial safe haven, stick around. You'll discover that whether you live in Shanghai or London, this sector could be key to giving your portfolio a bit of respite during tough times. Today, we'll discuss why investing in the luxury goods sector is worth considering. And as always, before we get started, I just want to mention that I'm not a professional financial advisor. My aim is to share data-backed analysis to help you make informed decisions. But this is just an opinion, and I encourage you to do your own research before investing. If you enjoy this type of content, don't forget to subscribe to our channel, give the video a like, and check the description below for a link to our weekly newsletter. Now, let's take a look at 3 reasons why investing in luxury is interesting. The rise of global wealth and emerging markets. In recent decades, global wealth has significantly increased due to higher productivity driven by the implementation of technological processes in production. It's true that much of this growth has been driven by the United States, with an increasing number of wealthy people, and they're getting even wealthier. But it's equally true that a significant part of the growth has been driven by the rise of emerging economies like China, India, and Russia. Of course, all of this growth has led to increased demand for luxury goods in these markets, which has not only created a growing market, something that was once unattainable due to widespread poverty in 3/4 of the world, but it is still expanding at an average rate of 6.5% from 2025 to 2030. The value and status of a brand. We all know that luxury brands are associated with social status and prestige. In other words, consumers seek not only high-quality products, but also symbols that reflect their success and exclusivity. Have you ever attended a social gathering and pulled out a watch that you reserved for special occasions, just so people would see it and automatically know who you are? It might seem vain, but it's still very much true. In Western societies, this isn't as common anymore, but in emerging markets where there's a clear wealth gap between classes, this practice is much more common. Anyone who has just enough to distance themselves from the social group that they come from and appears to be part of the next one will do so without hesitation. And of course, this perception allows luxury companies to maintain high profit margins and customer loyalty. What's more, consumers of luxury brands aren't just buyers. In many cases, they're evangelists who wouldn't hesitate to talk extensively at parties about why they bought that Ferrari. In fact, according to a PwC survey, 67% of luxury consumers consider exclusivity an important factor when choosing a brand. Alternative investments in luxury assets. By this, I mean acquiring luxury items like art, fine wines, watches, and jewellery, not just as personal desires, but as investment assets in themselves. This is what some now refer to as alternative investments. If you can't invest in a limited edition Ferrari that will only be available to 4 sheikhs and 2 Russian oligarchs, be the smartest in your class and invest in the company that creates the illusion that this edition is limited. And the illusion that it's limited exists because they want it to be. This brings double value to the company: the sales of the limited series itself and its positioning as a luxury brand. And if we look at the Knight Frank Index, which measures the performance of luxury goods, here is its evolution from 2012 to 2022. But of course, which companies sell these cars or produce these fashionable accessories? Are they listed on the stock exchange, and how are they performing? Let's find out now. How to invest in the luxury goods sector. Well, like in any mature industry, we have several options: stocks, ETFs, and of course various funds. Let's look at 3 ideas that might be interesting. The first company we'll look at is Ferrari. A classic among luxury lovers, Ferrari is not only the second largest Italian company, but it's also well known for its legendary Cavallino Rampante icon and its Formula One racing tradition. In recent years, they've managed to translate this racing prestige into high-end models. The results? They maintain the exclusivity that defines them. Additionally, the company is fully committed to innovation, with new hybrid engines and cutting-edge electric components like the SF90 model. In other words, they're striving to stay at the forefront without forgetting their racing DNA. And in terms of numbers, Ferrari has shown solid growth. Its operating margin, what we usually call EBITDA, rose by 43% in just 2 years, and free cash flow has doubled in just 3 years. As for dividends, although the yield is low, just over 0.6%, 10%, the company has increased it by over 40% in the last 3 years, and the payout ratio is around 30%. Next, let's look at Kering. In this case, we're talking about one of the most prestigious luxury conglomerates in the world, owner of brands such as Gucci, Saint Laurent, and Bottega Veneta. Their position in the luxury market is enviable, primarily driven by demand in Asia. However, financially, the company is not in the best shape, mainly due to a drop in sales in China. But this is where the opportunity may lie. Its EBITDA fell by around 11% last year, but it's similar to the level it had in 2021 when the stock was nearly twice as expensive. Moreover, its financial position is strong. The solvency ratio stands at 1.6, a very solid result. And if we look at the dividends, they're quite attractive. The company pays €2.88 per share, which gives a return of 4.4%. If we look at the price to earnings ratio, it's about 15, suggesting it might be undervalued if sales improve in Asia. And as for the chart, where might the entry point be? It seems the company has found solid support around €250 to €260. In fact, if we look closely, we can see an extraordinary increase in volume, and the RSI indicators shown bullish divergence for over 6 months. Sure, it can be scary to enter now after a 70% drop from the highs, but that's where the opportunities tend to be. Even so, it's always a good idea to set a stop loss between €200 and €205 per share, just in case. And now let's move on to something different, more attractive for conservative investors. This is the Amundi S&P Global Luxury UCITS ETF. To conclude, here's an indexed option. The Amundi S&P Global Luxury UCITS ETF, also known as AFID, is managed by Amundi and is one of the most popular ETFs for investing in the global luxury sector. Its goal is to replicate the S&P Global Luxury Index, which includes leading companies in the premium goods and services sector, with a weight for the largest companies. The top 7 positions alone account for nearly half of the ETF. On the other hand, the index it replicates is priced in dollars, so the ETF uses synthetic replication with swaps, allowing it to closely track the performance of S&P Global Luxury. It also has a management fee of 0.25% annually, which is quite reasonable. And all of this has led to a return of about 65% over the past 5 years. Not bad for a conservative investment, right? In short, growth, and more growth. And while other sectors come and go with economic cycles, luxury seems to be immune to crisis. And before you go, give the video a thumbs up if you like this content, subscribe to the channel so you won't miss our next videos, and of course activate the little bell so you will be instantly notified about each new post. Thanks for staying until the end, and we'll see you in the next video.